The stock market keeps breaking records, but beneath the surface, warning lights are flashing red. We're watching one of the most distorted rallies in modern history, a non-stop melt-up driven not by real fundamentals, but by fear of missing out. Rising unemployment, slowing growth, and extreme concentration in a handful of megastocks all point to an inevitable reckoning, one that could be more destructive than the crashes of 2000 and 2008. FOMO, not fundamentals, is driving this rally. Markets are supposed to reflect earnings, productivity, and economic strength. Today they reflect raw emotion, investors and fund managers terrified of being left behind. Every dip is instantly bought, not because the economy is improving, but because missing out could cost careers. Portfolio managers are under pressure to own the same names as everyone else: Apple, Nvidia, Microsoft, Amazon, Meta, Alphabet, and Tesla. If they don't, they underperform and risk getting fired. That herd mentality keeps money pouring into the same few stocks, pushing valuations to absurd levels. A market more concentrated than ever, the so-called Magnificent Seven now make up more than 30% of the S&P 500's market value, a level of concentration unseen in history. When a handful of companies carry the entire index, the market becomes fragile. If even one falters, the whole structure shakes. Nvidia's trillion-dollar valuation, built mostly on AI hype, shows how detached prices have become from earnings reality. Rising unemployment, yet stocks keep climbing. In a rational market, layoffs and slowing job growth would cool prices. Instead, Wall Street cheers weak economic data, betting that the Federal Reserve will rescue it with rate cuts. But inflation is still sticky, and the Fed can't slash rates without reigniting price pressures. That leaves markets suspended between fantasy and fragility, soaring on expectations that can't all be true. The passive investing time bomb. The explosion of index funds and ETFs adds another layer of risk. Passive vehicles automatically buy the largest stocks in proportion to their market weight. When Apple or Nvidia rises, these funds are forced to buy even more, a feedback loop that feeds the bubble. When selling finally begins, that loop will reverse. The same funds that push prices up will dump shares on the way down, accelerating the fall. Liquidity could vanish in seconds. Echoes of 2000 and 2008, but worse, the 2000 crash was about speculative tech. The 2008 crash was about toxic leverage. Today's market combines both, speculative valuations and record leverage, through options, margin loans, and derivatives. The entire system is leaning on a narrow set of overowned stocks. When that concentration unwinds, it will ripple through pensions, ETFs, and 401ks alike. The calm before the storm. Everything looks unstoppable now: record highs, record optimism, and record complacency. But bubbles always feel safest right before they burst. The larger the gap between hype and reality, the harder the landing. When fundamentals finally return, whether through disappointing earnings, a policy shock, or a credit squeeze, the correction will be fast and brutal. The next crash won't just deflate prices. It will deflate years of misplaced confidence. A message for viewers. This isn't fear-mongering, it's preparation. Markets built on hype eventually return to math and reality. The next correction could be historic, and those who plan ahead will come out stronger. If you found this breakdown useful, hit the like button, subscribe to the channel for no-fluff financial analysis, and turn on notifications so you don't miss our next video on how to protect your investments before the storm hits.